Today's topic is, of course, the Fed. There isn't any other topic this week. And you might say for the past 5 years, there really hasn't been any other topic except what the Fed is going to do. And I'm not sure the Fed knows what it's going to do or knows what it should do. But we will go through how I view the Fed decision and what I think they're going to do and the constraints that they have created for themselves. You might say that the Fed dilemma, the world market dilemma at the moment, is a product of the old-fashioned Greek trait of hubris. But before we start, those of you who sat through my webinars before know that I prefer to run them interactively, as they say in the modern world. I think I'm identifying too much with the antique world here, probably something I watched on TV last night. So if you have any questions or comments or Q&A or anything that you want to add to the discussion, please do, to myself or to anyone else who is listening. And I will be glad to stop and take a look at what we're talking about and see if we can come to some kind of answer for your question or any comment. This is a history, the longest I could find on Bloomberg. All the charts are Bloomberg, by the way, for the Fed rate policy, going back 45 years, basically, 44 years to 1971. You can tell that we are in, shall we say, an unusual period in Fed activity. The peculiar thing that you might note is that the two important things about this chart. The first is from the 1980s until now, from Paul Volcker, who is still alive. He's in his mid-80s, I think, and if I recall, he just got remarried like 3 years ago or something. I don't know anything about the personal aspects of Mr. Volcker's life, except that clearly he's an active man, at any rate. He's also very tall. He's like 6'4", 6'5". I have never met the man. Anyway, so the two most important facts about this chart for the Fed funds rate. And the Fed is the world's central banker. You can say what you want about the U.S. and its position in the world economically, but the reason the Fed is the world's central banker is because the world's currency is essentially the Fed, is what is the U.S. dollar. The Fed's responsibility is to the United States. Remember, Yellen and Fisher and the rest of them and Dudley and all the rest of them are federal government bureaucrats. They're economists. Most of them are academics. Very few, if any of them, come from the private sector. In a sense, that's where their greatest experience and that's where their worldview is from. But they are government officials who take an oath to perform their role. And their role is limited. Their role is limited to what Congress tells them to do. And Congress has told them to do your best to enable full employment and inflation, control inflation. And it doesn't say worry about the Brazilian real. It doesn't say concern yourself with emerging market currencies. It doesn't say worry about the price of oil. Now, the policy that the Fed takes has an enormous impact on those things and the entire world economy, because the world economy, in its trade aspect, runs largely on dollars. I've been so many places in the world where if you want to, the international trade of that country, that place, that entity, that city-state, all relates directly to its exchange rate in dollars, and dollars are the medium of exchange. How does a country like Zimbabwe function when they're running, 12,000% inflation rate? Simple. Nobody uses the local currency. They use dollars. and on around the world. So although the Fed's mandate is for the U.S. economy, the Fed's impact is clearly worldwide. So back to this chart, the two most salient factors of this chart, this is the Fed funds rate going back to 1971. You could say 3, but I'm going to just 2.5. The most striking thing immediately is this escalation of rates in the early 1980s under Paul Volcker to squash inflation, which worked. You have the Fed funds rate 3 times at 20%. Astonishing. What do you have after that? And this is actually the most important factor of this chart because it relates to everything else. It relates to why the Fed, fantasizing, if you will, about 2% inflation, can't get the market there. It's this. The slow decline of interest rates over 35 years. The world's central banks have been remarkably effective, or so it appears, at quelling inflation. This, you could almost say, regardless of the financial crisis in 2008, that this zero interest rate, 0.25 upper bound for the Fed funds rate, is the logical conclusion of this chart. It is the trend where this chart is pointing. Regardless of the necessities as viewed from the Eccles building, which is where the Fed is in D.C., of supporting the economy throughout the period after the financial crisis, this is the logical progression of this chart. There's another logical progression as well. Trend lines can be, as we know, extended ad infinitum. They are, but when you do that, of course, you extend them beyond the bounds of logic. You extend them beyond the reality of the world. But the logical continuation of this Fed funds line's trend line is where? Well, obviously, it's negative rates. You could almost say, if you draw the trend line, I don't know, probably not from here, but any place you draw it, this zero rates is a defensive move by the Fed to keep it from going into zero rates. I don't believe that, but I just want to point out, and I can't stress too strongly, that the part of the situation that the central banks find themselves in are, they think, a result of the success of this chart, meaning quelling inflation. But it's also possible that there is another factor here. That the makeup of the world economy, if you will, the aging of the world economy, certainly from 2000 on, also contributes to deflation. Okay, so that is the salient point of this chart, is the decline in rates over the past 35 years. So now let's look at the Fed's dilemma about rates from two different points, from one point of view, and then from the point of view that I find most illuminating. Most of the commentary about the Fed funds rate is focused on their data-driven mantra, which I find at this point utterly nonsensical. A month ago, 2 months ago, 6 months ago, they're all saying the same thing. The Fed's saying the same thing. Well, we want to raise rates, but it depends on the data. Nonsense. It only depends on the data at the extreme, at least at this point. If the economy, as I said in my write-up, if the U.S. economy was producing 100,000 jobs and had been over the past 2 or 3 years, we wouldn't even be discussing this. Nobody would be raising rates. If the U.S. economy suddenly plunged into recession or something like that. We wouldn't be discussing this. It's at the extreme where it's data-driven. If you look at almost any of the criteria, and let's look at the ones that the Fed prefers. Okay, let's look at the U3 the Fed funds, the U3 unemployment rate, and non-farm payrolls. This is the biggest focus of the Fed. So the Fed is saying we are data-driven. In other words, we're technocrats. We're not doing this because we have an idea about where rates should be. We're not doing this because we have a worldview. But of course, that's nonsense. We're not doing this because some theory tells us to do this. We're data-driven. We're purely executing, but executing what? Any decision, of course, in a realm like this is operating on assumptions, and so is the Fed. So all of this insistence that they are data-driven is marginally true at best, and at worst an utter distraction from what's really going on. So this is probably the key, so the Fed says, for its decision. Fed funds rate, U3 unemployment rate, and non-farm payrolls. Now, non-farm payrolls, how should I put this with being delicate? I probably shouldn't be delicate. These two statistics out of the federal government are probably two of the most massaged, if you will, or at least adjusted in the federal government's repertoire. U3, for obvious reasons. The only people that are counted in the unemployment rate, I'm sure you all know this, but I have to repeat it because it's a description of the statistic. The U3 unemployment rate, the only unemployment people are counted are those who respond to a survey and actively look at and say they actively looked for a job in the prior month. If any of them have been out of work for a long time, I'll tell you that there are months where and I've not been, but I know that it's true because I know people who have. After the initial flurry, there are months which are kind of depressing, and you don't do much for look for a job, and then you crank yourself up and do it again. I know when I graduated from graduate school, it took me a year to find a job, and I will tell you that I was not actively looking all that time. So the U3 unemployment rate, as far as a measure, is phony. It's not phony in the sense that in the variation of the rate, there's information, and that's true. It is certainly true that unemployment has come down in the United States. But the level to which it's at right now, and you could also say the rate, but primarily the level, is a function, as we all know, and I did not put this up there, but I have another chart with it, but I'm sure you all know it anyway, of the labor force participation rate, which is at a almost 40-year low. Yes, there's a certain portion of that is due to retiring people from the baby boom, my generation. Also forced part-time as well. Another fallacy or another problem with the U3 unemployment rate is if you get a part-time job, you're counted as no longer working. Well, that is a false statistic. I mean, you are, in fact, in an absolute sense, no longer employed. And so you are subtracted from the unemployment rate. This 5.1% is largely a product of the collapse, and I do not use the term lightly, in labor force participation. Let me just give you my labor force participation graph here. It's kind of tough argument. Let me find it here. I'm sure I have it somewhere. No, I may not, Part of my ritualistic discussion with the imaginings of... here it is. I do have it. Okay. Here we go. Ta-da! So, we have Fed funds rate. There we go. That straight line on the bottom never changes. We have the Labor force participation rate is the green, and the average hourly earnings are yellow. So let's compare this to the prior chart. Hold on. Just move it aside here. Oops, what happened here? Oh, that's strange how this works. Okay, anyway. So I have the unemployment rate, non-farm payrolls here, and here we have the, let's go. There we go. Okay, so the Fed funds rate, well, back to the unemployment rate. So we have the unemployment rate here, and you can see that the decline in the unemployment rate is absolutely analogous to the decline in the decline in the labor force participation rate is absolutely analogous and in time coincident with the decline in the unemployment rate. So when you look at these statistics and start using them, I'll tell you that in a second. I see that one. The Fed's use of this statistic is self-serving, and the changes that have taken place and how this is accounted for are also self-serving. They're self-serving to the bureaucrats in the federal government. If the unemployment rate, if the labor force participation rate was around here, what it was, had remained at a level as it normally does in a recession. It goes down a little bit, but then it comes back up. And this has not come back up. It is sitting on the bottom. That is telling you that people are simply giving up. They're not going into the workforce. They're not all retiring. They simply have no choice. But at any rate, if the labor force participation rate was 2 or 3 points higher or 4 points higher where it was when the recession started, then the unemployment rate would be somewhere around, say, 7 or 8%. There is no way that the Fed can credit, and now the Fed knows this, they can credit that rates need to be raised with a 7 or 8% unemployment rate. All right, let me answer this question, then I'll go back to this. It doesn't, that has an effect in a delay on the unemployment rate. But what, as far as starting a new job, what that directly affects is the non-farm payrolls. Because what the non-farm payrolls do is they are, when the numbers come out for a particular month, I guess that's the Bureau of Economic Analysis, part of the Labor Department, or is it the Commerce Department? Commerce Department. They estimate the number of new jobs that they think have been created through the starting of businesses. And they factor that in. You will look sometimes in the details of the non-farm payroll report, and you'll see that they estimate 300,000 jobs or 150,000 jobs were created. They don't know that. But they do have a handle on how to figure it out. But it takes time until the statistics get through because they have to report, of course, their income. And they report their jobs and things like that. So they do get a hold of it, and that's when you see the adjustments to the non-farm payroll report. The unemployment rate comes from what's called the household survey. And this is the reason that they don't put the unemployment rate on established businesses, because you would miss new businesses. And the household employment rate is, the household survey is conducted by actually phoning up some random sampling of households and saying, are you working or not? So that's where it comes from. So if you are founding a business and the government calls you and say, are you working? You'll say yes. So in that way, the unemployment rate should, because it's from the household survey, it should incorporate new businesses and just founded businesses. The non-farm payrolls does it by estimation, and then at a later date through their revisions by the actual reportage from the new businesses. I assume they get the information from the IRS. I don't actually know where they get it from. Okay. The last aspect of this particular Fed view of the world which, again, on the unemployment rate, it's essentially false. The unemployment rate is not really 5.1%. I mean, it is by their standards. It's like trying to define normal. Lots of problems with it. You have to have a set of assumptions first before you can define normal for almost anything. And it's the same with this. They've changed the assumptions on the unemployment rate, and in fact, the unemployment rate is hardly 5.1% by historical measures. The other problem we have, and the Fed has spoken about this, wages. The purpose of zero rate policy, from an economic point of view, is to support the economy, to support the demand side of the economy. Well, if we look at in a 70% consumer-driven economy, or whatever the number is, if we look at what would be the most important criteria if you need to go out or want to go out and buy something? Well, you need to have enough money, or perhaps you need to be profitable and just put on your credit card. But either way, let's assuming the logic that you need to count on more money. You need to have the money to spend before you spend it. Well, what do we see for the average hourly earning year on year? There's hardly any change throughout the period beginning in 2010 for the last 5 years, 1, 2, 3, 4, 5.5 years. There has been almost no change in average hourly earnings. Nobody is getting paid. And I will tell you, I can speak for this in a personal. It's much, much tougher to come by a raise than it used to be. That also tells you that the unemployment rate is probably inaccurate. Because if the unemployment rate really was edging down towards what used to be considered full employment, then the pressure on wages would be far greater than it is. So we can look at this chart as well and say that zero interest rates have had almost zero effect on average hourly earnings. And you'd say that it's the same thing for personal income. Now, is this normal? No. Because if you stretch this chart back 30 years, you will see that the increase that we've seen in the past 5 years has been a little more than half the average of the prior 30 years. So the historical comparison is not beneficial to the Fed funds rate and its as a policy, its successful policy. Now, the argument that I'm not going to address, because it's impossible to address, is the what-if argument. Things would have been worse if we hadn't done this. Since there's no way to prove that, it's not useful as an argument except as a way to defer criticism. Okay. Let's look at some of the other standards for what the Fed is discussing. So we can see that for this criteria and for these criteria, the change that the Fed is looking for, when the Fed says that they're data dependent, well, what are they looking for? Are they looking for 300,000 jobs a month? They're not going to get it. Are they looking for 4% unemployment rate? They're not going to get it. The statistics have been, and this is, let me pull that one up again. Where's that one? I shouldn't have closed it, I guess. Here we go. Another thing that's striking about this average hourly earnings is the lack of variation, the lack of trend. If the Fed is waiting to return to historical levels of increases in average hourly earnings, I hope they're patient, because this uptrend is phenomenally gentle. I don't know, I didn't project this out, but at that very shallow up angle, it might take you to 2030 to get back to 3.5%. Is the Fed going to wait that long? Hardly. Same thing is true of non-farm payrolls. There is an uptrend depending on where you take it, but it's not strong. And I should have run the quarterly average on this, but I didn't. Sorry about that. There's an appreciable improvement back to here. But for this period here, look at this. It's not going anywhere. Let's look at some of the other statistics that we have here, some of the other stuff I have here. Okay. Factory orders. Data dependent, huh? I hope not. This is year-on-year factory orders. This is the collapse in the great financial collapse. This goes back to 1985. Look at where we are. This is lower than the recession of 2000. I couldn't get this chart to go back any further than 1985. It's probably about the low of the early 1980 recession, 1981 recession, which was very, very severe. Data dependent? I hope not. Let's try another one. Okay, existing home sales. Here we have some improvement and a reasonable uptrend. You're now getting back to about, this is at the yellow, to about where you were as an average number. Of course, what's forgotten, we're dealing with absolute numbers here. What's forgotten is that this is 20 years ago, and the population was considerably less than it is now. So since you're dealing with numbers and not percentages in this case, this should be higher. Okay, let's deal with another one. I just did that one. Okay, personal income. Same thing. All of these statistics are not showing the type of return to historical norms that you would expect, that I'm sure the Fed expected. No one has ever tried this experiment of zero interest rates for 5.5 years. No one's ever tried this. So when you imagine what the Fed thought they were going to accomplish, they were winging it. They were basing what they thought would happen on two things. One, they needed to do something, and they really don't have anything else to do. And this has always been one of my strong points in argument for a long time, that the reason the Fed acts and the reason the Fed does this is because the Fed is expected to act, and there isn't anything else they can do. Interest rate policy is their main tool. There really isn't anything else. Yes, there are requirements for various banks to hold various deposits and stuff like that. But the main tool they have is interest rates. Quantitative easing is nothing more than interest rate policy taken one step further. So they have one tool, basically interest rates, and that's why they act with interest rates. But when the Fed started this policy, they were basing on assumptions as to what they thought would happen. And it appears that you have sort of a quantum effect here. You know, the idea of quantum mechanics is that the act of measuring changes the measurement. And the idea that the effect of interest rate changes are the same at all levels of interest rates is clearly untrue. In other words, if you drop interest rates here from, where are we here, this is in 2000, from 6 down to 1 point, whatever that is, 1.8, you will have an economic effect. And you can see that. Here, once you are at zero, you are smack up against the law of diminishing returns. The reduction from 2 to 0.25 is not the same as the reduction from 3.75 to 2. Now, the Fed may have assumed that that was the case, but now they have empirical proof. Call it the quantum effect, if you will. Well, that's probably not a perfect analogy, but it's close. The change in policy is not the same depending on where the policy starts. Okay, so again, back to the data-dependent Fed. What change could they get here that would tell them it's time to raise rates? We haven't seen any yet. All right, let's look at this one. This is manufacturing ISM. Now, it's a sentiment number. It's not a hard number. It's a sentiment number. Nevertheless, the ascent here is non-existent. Yes, it came up from the trough, and it had a peak here, but it goes back and forth. There is no sense that this is providing steady improvement. Okay, let's look at another. If you're not getting the improvement in wages, which we saw, and you have a 70% driven economy from the consumer, then what else are you going to do? Well, you can get credit. So let's take a look at credit, okay? This is revolving credit. No, this is non-revolving credit. Whoops, I want revolving credit. Hold on, right here. Oh, here it is. I'm sorry, I have both. Excuse me, forgive me, I have both on this chart. Made a better chart than I thought. Green is non-revolving, and yellow is revolving. Yellow is essentially credit card debt. And non-revolving is all sorts of term loans, primarily car loans and education loans that have a set amount and a set term. Look at the difference. The revolving, which is your credit cards that you pay, 19% on, returned to more or less its historical norm and stayed there. Now remember, these again are absolute numbers. We do not have the same population in the United States that we had 20 years ago. So these are not corrected for changes in population. If they were, the chart would look considerably different. Okay, but it's too complicated to do, and I didn't want to get into all the mathematics for doing that. And I'm not sure I know how to do it on a chart anyway. But these could be corrected for population factors. You could do it per capita, and you'd see an entirely different display here. But that aside. So this return to the norm of back here is not nearly as good as it seems. Okay, I think we have a 45-minute period today rather than a 50 or 60-minute period, so I'm going to go through this, and then I'm going to talk about what I think the Fed is up to and why they're making a decision. So if you're looking for a spur to where the U.S. is getting its spending from, it's right here. They're largely borrowing it to buy cars, because the U.S. fleet had aged to its oldest on history back from the recession. And they're borrowing it from the federal government in education loans to go back to school. Look at the difference in this. The historical measure for education loans is back here someplace, and we're now averaging about $15 billion a month. Entirely different number. Okay, so two more things I want to take a look at. So the Fed's data dependency is, in a sense, a dead end, because none of these statistics, especially the ones that they care about, right? Where are we? This one. Income, labor force participation, and unemployment rate. None of these are going to change appreciably. When the Fed 2 months ago said that they're data dependent, it's not quite time yet, what do they expect? This month, there's going to be a change that's going to make it okay? No. Nonsense. The numbers are trend numbers. 1 month doesn't change. Even if you got 600,000 jobs, one, it probably would be false, but two, it wouldn't change the trend. It would not signal the advent of a new trend. So the idea that the Fed is data dependent, in a sense that new data coming in is going to enable them to enact a certain policy, is nonsense. The Fed knows what they're going to get for the next 6 months, unless something happens and it gets worse, because it hasn't changed. So in that sense, the Fed's data dependency is not an accurate, it is a publicity item. Okay, so if the Fed, these are smart guys and women, men and women, they know this. So if the Fed is not making its decision, and in my mind they're not, on data dependency. In other words, as I said, the data dependency is at the extreme. If things are much worse or different, the Fed would not be raising rates. Doesn't matter. If things were much, much better, if we were making 400,000 jobs a month, average hourly income was rising at a 3.5% rate, and unemployment was down at 4%, the Fed would absolutely be raising rates regardless of anything else. But again, those are at the extremes, and we're not seeing that. In the current statistical economic picture, it's not going to change that much. Okay, so where are we? So what is the Fed going to be basing its decision on now? And the Fed seems determined to raise rates. Well, let's take a look here. Okay, this is emerging markets currencies. This is DXY. This is the white is emerging markets. The yellow is the Bloomberg Commodities Index. Green is Fed funds rate. There is a sense of coordination to these charts, as you would expect. But the change is traditional in the sense that the market is anticipating a rate move. The credit markets do not see this in the credit markets. You do not see the the rates rising. You do not, which is the result. If this is exactly what you expect, if right around here people started to believe that the Fed was going to raise rates, which is in fact what happened. The emerging markets rates is a little different. It has fallen much harder, but it still has the same aspect to it. The same thing with the commodities index. Okay? Now, two things are going on with the commodities index. One is that you had this collapse in 2008, but still, from here and the same point, the collapse has been much more profound. So these markets are telling you that we're anticipating a Fed rate hike cycle. The credit markets are not telling you that. Somebody's going to be wrong. Actually, you know what? They're both going to be right, and I'll tell you why. Even if the Fed raises rates on Thursday by a quarter point, they are not starting a cycle. The Fed, throughout this period of the past 5 years, has wanted and tried very hard to have it both ways. It wants the market to consider that rates are not going to be low forever, but it doesn't want the credit markets to raise rates because it's afraid of what rates will do. So I think that the Fed's position is largely based, as I said earlier, not on data, but on outcome. What do we need to do, and why do we need to do it now? The idea that started with Alan Greenspan, that central banks and their rate policy have an ability to mitigate, ameliorate, perhaps do away with business cycles is a pernicious idea. One, it's not true. But two, it's dangerous because it takes away one of the primary functions of a business cycle. It's a capitalist function. It weeds out the dead wood. And when you take that away, you undermine the ability of capitalist systems to produce. So there is a recession coming. That's like saying every time you speak, you're closer to death. Of course that's true, because time moves on. Same sense here. There is another recession coming. Some of these statistics, sort of like this one, make it look like it's very close. I don't think the Fed has any clue, and I don't have any clue either whether it is. I think my feeling is, yes, it is far closer. So the Fed needs to raise rates to give it some sort of leeway for something to do when we get the next recession. The problem is, of course, is one rate increase to 0.25 going to make any difference? Remember what we said earlier. The effectiveness of interest rate policy is not the same across the entire interest rate band. At the zero rate, zero bound, interest rate policy seems, in its economic effect, to be extremely ineffective and increasingly so. What else has the zero rate done? It has created an enormous pile of debt. Everybody's borrowing money, mostly to buy back their stock in the corporate world, but also to fund all sorts of marginally productive investments. The world economy is very oversupplied. There are too many car manufacturers. There are too many oil producers. There is too much ore being mined. China has too many factories making all sorts of things. One cause for all this, is the ability to access cheap capital resources and create these things. On the other side, the result is deflation. Again, let's look at one more thing here, which I did not cover earlier, and I just want to look at it. PCE. These are the core ones. These are core numbers, the ones the Fed are looking at. Okay, look at this. Do we see any sense that there's a change in trend? The Fed keeps talking about unemployment rate inflation returning to 2%. It certainly does not look like it's going anywhere near that. So again, data dependency is a false god, if you will, that the Fed is following, and the Fed knows this. Okay, let me answer one of these questions. That's a very good question. And it's true of this chart as well. What is anticipating here? Nobody at this point in any trading market can be anticipating this kind of rate cycle. This, or this, or this. The Fed is not going to, even if they raise rates on Thursday, which I tend to think they will, because they've completely boxed themselves into a corner on this one. And the only reason they wouldn't raise rates now is because they'd be afraid of the effect. But the only reason there would be any pronounced effect is if the markets would assume that this is the start of a rate hike cycle. They've already assumed that there'll be a rate increase. At least some of the markets have. The credit markets are telling you whether or not the Fed raises rates on Friday, it's irrelevant. They're telling you there isn't going to be any rate hike cycle, and I think that's correct. So the idea that this is an important decision is in a way very phony, because it isn't going to change. Whether the U.S. rates are 0.25 or 0.5 is going to have the most marginal effect, because on the markets that are trading on rates, currencies included, the effect is already in. It's largely a speculative effect. On the credit markets, there's no change. You look at the 10-year, you look at the 2-year, you look at the 30-year in the U.S., there is no sense that the Fed is going to do anything substantial. So, I will wrap up here. I thank you for listening. Keep that in mind when we listen to. I'm quite pessimistic for the immediate future. I just do not see that where economic growth can come from until you have a recession, and I do not see that the Fed has any, or any of the other central banks in the world have any real tools left. Okay. Thank you very much for attending, everyone. I hope this was interesting and useful, certainly not humorous. And I thank FX Street for the facilities to put these on for you. We will be doing another one in about 2 weeks. I will put my email address up there. I know there's another one coming. If you have any questions or comments, please send it to me, and I will be glad to answer. Take care, everyone. Have a good day.